Very often I get this question, what is the difference between debt equity ratio and TOL by TNW ratio? Even though it seems like both are used interchangeably, there is a difference. This debt equity ratio will be mostly used in the context of term loans. That is, banks will be arriving at cost of project means of finance. So here they'll be listing all items that have to be purchased for the project, and they'll be listing out what are the sources available for meeting the cost of project. One is the term loan and other one is the margin that the borrower has to bring in. This margin can be a composition of fresh capital, that is equity. It can also be utilization of the profits made by the business. They call it as internal accruals. So here they'll be comparing this margin with the term loan. So this margin will be overall called as equity, and that will be compared with the term loan, and that's how they arrive at debt equity ratio. Whereas TOL by TNW ratio, that compares the total outside liabilities of the business. These will be compared with the tangible net worth to frame an overall position of the business. That is, what is the overall long-term solvency of the business? That is the picture we get by calculating TOL by TNW ratio.